The Mega Millions lottery just crossed over $1 billion and is officially the second largest jackpot in game history. And so everyone's talking about what they would do if they won that amount of money. Hey Sean, look, I just won the lottery. But first, there's a very important decision to make because, okay, when you win the lottery, you have two options. You could either A, take a lump sum payment option, or B, take an annuity or annual payouts. And there are some serious pros and cons of each option. Now, before I get into the details of what I would do and some calculations, I'm curious, okay, which option would you take? Tell me down in the comment section below. And also, let me know if I changed your mind after you watch this entire video, because today what I want to do is cover the lump sum option versus the annual payout option, go over some investing scenarios and calculations to see which option is better, and then reveal how previous lottery winners went completely broke by choosing the wrong option. All right, let's talk money, starting with chapter number 1, lottery sum versus annual payouts. So here's the thing. Even though the lottery is currently advertised and valued over $1.1 billion, the winner won't actually receive anything close to that full amount. And that's because of two big factors. Okay, first factor, number 1, the payout. Because when you take the cash lump sum option, then you're only allowed to take roughly 60% of the lottery winnings, which means that $1.1 billion you thought you were going to get suddenly turns into only $648 million. So basically, you'd be giving away $400 million. Hey Sean, look, I can throw money in the trash. Okay, but look, I hear someone out there saying it. And yes, okay, $648 million is still life-changing money. However, let's look at the annuity payout. Okay, with this option, you get the full $1.1 billion, but you have to take it over a 30-year period, which comes out to be about $37 million per year. And yeah, that's still life-changing money as well. Okay, so that's one big factor. The second big factor is number 2, taxes. So going back to the lump sum option, after you receive the $648 million, then you would also be taxed at a 37% tax rate, which is the federal tax rate for any individual that makes over $539,900 per year as a single tax filer, or $647,850 per year as a married filing jointly taxpayer. But anyway, at that rate, you would pay about $240 million in taxes. But wait, there's more. You'd also have to pay state taxes as well. In worst case scenario, if you live in a state like California, then you're going to have to pay an extra 13.3% in state taxes, or $86 million. So instead of getting the $1.1 billion that you thought you won, you'd actually take home an estimated $322 million, which is only 30% of the total lottery. On the other hand, if you took the annual payouts, then again, you get the full $1.1 billion prize. But you still need to pay federal and state taxes. So I guess the only guaranteed winner of the lottery is Uncle Sam. Anyway, under the same circumstances as before, the lifetime tax amount on the annuity would be roughly $553 million. However, there are some tax strategies that you could deploy to reduce the taxes paid on the annuity over time. So in this scenario, the lump sum leaves you with $322 million and the annual payout leaves you with $547 million, creating a $225 million difference. So how can you make up the difference? Let's talk about that in chapter number 2, investing scenarios and calculations. But really quick, before I move on, if you're appreciating this video at all, please do me a favor and click the like button for the YouTube algorithm. It really goes a long way in helping this video reach more people like you who want to learn about taxes and the lottery. All right, number 2, investing scenarios and calculations. Now, there are some lifestyle factors that come into play when you're making your decision. One factor is age, right? Because if you're over 60 and you want to be able to afford the same type of live forever technology as Jeff Bezos, then I don't blame you, right? take the lump sum payment option. However, if you're under 40, then you've got some thinking to do. You've got some time and you could earn a lot more over your lifetime. Okay, so one scenario I often hear is, hey Sean, I could invest the lump sum payment and make way more than an annuity option, which is kind of true, but maybe not realistic, because in this scenario, you could take the $322 million and invest it into something like an S&P index fund, which historically generates about a 7% return, which then returns you $22 million per year. But here's my problem with that, okay? You just won the lottery. What are the chances that you're going to invest that entire amount? I think that's very, very unlikely. So scenario number 2 would be invest half of the lump sum option, which I still think is pretty aggressive. But hey, let's see what it looks like. Invest $161 million at a 7% return, and then you'd get about $11 million per year. Which means, hypothetically, if you realize $11 million per year, it would take you roughly 20 years just to break even with the annual payout. But of course, with compound interest, that could grow at $800 million after 30 years. So your portfolio could end up looking like $161 million in cash and an investment that grew to $800 million after 20% capital gains taxes, meaning you have about $961 million after 30 years. Okay, hopefully I'm not losing you with all the math, but basically you could easily make up the difference between the annual payout and the lump sum payout if you invested the money, right? Well, before you say yes, let's look at scenario number 3, because something that is often not factored in is that you could also invest those $37 million annual payouts as well. And since you're getting the money over 30 years, you could take some time to learn how to invest in other vehicles like rental properties or upcoming startups to get a bigger return. So if you took half of the annual payout and invested about $18 million at a 15% return, which is definitely achievable in real estate investing or private equity, then after a 30-year period, you would also end up growing your investment to roughly $800 million after 20% capital gains taxes. So the portfolios are almost identical. All right, so that's a whole lot of numbers and math. But to summarize, if you plan on being a good investor, then an annuity payment can still beat the lump sum option. On the other hand, if you are a bad investor or you just have no experience investing, then you could end up losing your big lump sum payout. In fact, nearly 23 lottery winners went completely broke, losing millions of dollars in record time. Let's talk about that a little bit more in chapter number 3, lottery winners who went completely broke. So first of all, if you win the lottery, please, please, please call me, email me, come to my house, whatever you got to do so that I can personally help you. By the way, my services start at $1 million per hour. Anyway, I read a great article that recaps how lottery winners went flat broke. One story involves a guy named Gerald who won a $10 million jackpot. Then he started blowing his money on cars, partying, gifts, and got into some legal entanglements, which I would guess are expensive lawsuits. And by the end of all of that, he ended up working for a farm before, ouch. Another story involves a guy named Mikey who won an $11.8 million jackpot, but he also blew his money on a lot of materialistic things. Then a few years later, he was caught working for a slaughterhouse for just an extra few $100s per week. Dang. And Jack Whittaker won the $314 million Powerball jackpot, which at the time was the biggest lottery winning in history. Now Jack, he was a giver. He gave donations to churches, he gave to family members, to strip clubs, and other places routinely. But perhaps he was too generous because he blew all his money and his life turned to ruin, ultimately losing his precious loved ones. The article goes on to account 20 other stories, which is actually an enjoyable / horrible read, which I'll link down in the description below. Now, all these stories have a common theme, and that is many lottery winners go broke because the payout is much less than they thought it would be, and they start spending uncontrollably on things they don't really need. or they make bad investment decisions trying to make more money because they have no investing experience. Or they slip into a deep depression and a lot of bad habits because, as they say, money can't buy you happiness. And it's easier to lose yourself when you have all the money in the world. Or the winners end up buying liabilities that they can't sustain because bigger houses and more expensive cars come with higher property taxes, higher insurance payments, higher maintenance costs, and those costs never go away. So maybe some of these winners would have been better off taking it nice and slow with the annual payouts. All right, so did I change your mind? Don't forget to tell me down in the comment section below which option you think is best. Coming up next, I have a video on the fastest way to become a millionaire based on my experience, other than hitting the lottery, of course, and another video on business ideas. So check those out if you haven't already, and I'll see you over there.